Okay, so today we're going to start Chapter 7, where we're going to be discussing the financial statements for sole proprietorship. We looked at financial statements a little bit back when we were in Chapter 1. At the end of Chapter 1, we talked about one of the sets of financial statements, which was the balance sheet. And we will talk about more financial statements. We'll spend a lot of time second semester focusing on financial statements, so that by the end of second semester, you guys will have a very, very good understanding of the different types of financial statements that businesses use and report. So we're going to start out by defining some accounting terms, and that's what you were doing in your accounting log. Okay. We will then go and discuss some of those accounting concepts as we go through the chapter. We've already discussed some of them in the previous chapters, but we'll expand upon that in Chapter 7. Then we will work on preparing an income statement for a service business and using the component percentages. And we will use, just in this chapter, the component percentages for income statements. However, next semester, we will do component percentages for both income statements and balance sheets. Okay, and then we will get into discussing and preparing a balance sheet and learn a little bit about what the purposes of both of these types of statements are. So, thus far, we've been working with all the different types. If you guys could do me a favor, for those of you who still have your laptops open, just close them down for the moment and focus on your notes packets, okay? Thus far, we've been talking about all the different steps in the accounting process. We started out by journalizing and then posting to our ledger. And then we use the information on our ledger to create our worksheet. Once a business has completed the preparation of the worksheet, that's when they can start to prepare their financial statements. They do all the adjustments on their worksheet, but then those two columns, or I should say really, the four columns out at the end are the information that are needed to actually start creating the financial statements, the balance sheet columns and the income statement columns. So all of the information that you need right now to prepare your balance sheet and your income statement is going to come from those columns in the worksheet. Okay. So why do we need this information? Businesses need this information. They take all that information that's in the ledger and the journals and so on and so forth. But as we've already discussed, it's not really so easy to get a good picture of how strong or weak your business might be by looking at all of that diverse information. So businesses take that information and consolidate it into what we call financial statements, and two of those primary financial statements are the balance sheet and the income statement. So they consolidate all that information there to make sure that it's useful and that it's organized so that business people can interpret how well that business is doing. And then we have some of these accounting concepts, meaning one of them being adequate disclosure, because businesses have to provide what we call adequate disclosure in their presentation of their financial information. And basically all it is that when the financial statements are prepared, they have to contain all of the information that is necessary to basically present the financial condition and operations and performance of that company in a fair and reasonable fashion. Okay? So one of the things, how many of you have heard of the company Enron? One of the biggest corporate failures ever in the whole entire world. Okay, one of the problems with Enron was that they didn't do this. They did not provide adequate disclosure. Okay, they did not present all of the information that they were supposed to present in their financial statements, and as a result, people were investing literally billions of dollars in that company. And then the company ended up failing. And, when you're investing, you're relying upon the information that businesses are presenting to make your determination as to whether or not you should invest in that company. So if they're not adequately disclosing how they're doing, you're making your investment decisions based on incorrect information. It would be like you guys trying to read a book and pages being ripped out of the book and then you thinking that you understand the story when there are whole sections of the story that are missing. Okay? So it's inappropriate and it's unlawful, quite frankly, for businesses to do that. So one of the things with Enron is not only did Enron end up going bankrupt as a result, but at that time, the CPA firm, Arthur Andersen, who actually was the company that audited their financial information and knew that things were not being presented adequately, they ended up failing as well. And at that time, Arthur Andersen was the 5th largest accounting firm in the world, and they ended up dissolving as a result of not even their own failure, but of Enron's failure. Because after that, no businesses really wanted to deal with Arthur Andersen because they felt like, okay, if they would turn a blind eye to other companies like Enron reporting improperly, then what else were they doing or not doing properly? So it resulted in multiple companies failing. Then we have the accounting period cycle concept, which basically says that financial statements have to be prepared at the end of each fiscal period. We discussed that as well in Chapter 6, I believe. And then we have what we call the going concern concept. The going concern concept is applied when financial statements are prepared with the expectation that the business is going to continue to operate indefinitely. So when you're analyzing a business, if you ever see in their auditor's report that the auditor says that we have a concern as to the ongoing nature of this business, that's like a huge red flag, okay? And that's one of the things that the CPA firm is supposed to report on. A CPA firm is supposed to report whether or not they think that there's any going concern issues relating to that company. Because if there are, it's a red flag that the company may not be in existence all that much longer. Or they may have to sell off parts of the business to keep other parts of the business going. Okay, so that's a huge issue or concern. So we're going to first look at what we call the income statement. And can anybody tell me, what did they say in your reading and your accounting log? What did they say the income statement does? What does the income statement do? Look at your accounting logs. What does it do? Sean, what does the income statement do?
It reports the financial information over a specific period of time, indicating the financial progress of the business.
Good.
Net income or not.
Good. Excellent. Okay. So the income statement, really important here, the income statement is for what we call a period of time. So whether it's a month, a year, a quarter, could be a week, but you don't usually report on that short of a period. But generally the shortest period is a month. And it's showing the financial progress of the company over that period of time. Specifically speaking, we're talking about your revenues and your expenses. And it's showing you whether that business has reported an income or a loss for that period of time. So did they sell enough stuff to cover all of their expenses for that period of time? Clearly that's important, okay? It's like you guys, as you're working now, and when you start working for real, like when you graduate from college, you want to obviously make enough income to cover all of your expenses. If you're not, you're kind of in a little bit of trouble, right? You either kind of figure out how to reduce your expenses or work harder and earn more money, okay? Same thing for a business. They have to do the same type of thing. And again, in our income statement, we're helping to apply the matching of expenses with revenue concept. We're trying to demonstrate that the revenue that we earned and the expenses that were incurred are reported in the same fiscal period. And we know that that's somewhat simple when we've got a company that sells like retail products, you know, like you go to Target, you know, they buy inventory, they sell it, blah, blah, blah. Pretty simple to figure out how to match those revenues and expenses. More difficult when you have something like a bridge construction or a road that's being built or a building that's being built or an airplane that's being built, where it's taking a longer period of time. And so how do you match up those expenses with the revenues that are being generated, because they may not show those revenues until a later point in time, but you have to account for it. Okay, so first thing when we start our income statement, we're going to start with a heading, and our heading has 4 sections. So our heading has 4 sections on our income statement. The revenue, expenses, and net income or our whole income statement has 4 sections. The heading, the revenue section, the expense section, and whether we have an income or a loss. So we'll start with our heading. And our heading on our income statement starts with the name of the company, what the financial statement is, and then what the period is. Okay, so this is important here, what the period is, okay, because in an income statement, different than a balance sheet, we're talking about a period of time. So in this, we're going to center the name of the company, we're going to center the name of the report, and we're going to center the third line, which is the date information. Then we're going to take the information that we have in our, where are we getting all the information for the income statement? The worksheet. We're going to take that information from the worksheet and we're going to present it in what we call financial statement format. Okay, so these columns here, okay, are not debit and credit. Don't think that way. That's not what they are in an income statement. Okay, we're going to think of these as total columns, if you will, and then the details column. Okay, let me put that up here. So these are the totals. Oh, it's going to do this thing again. This says totals, and this says details. Okay. So we first start out by putting the title on the left side of the account title column. Okay, and we're going to say revenues. And then we would put the details as to each individual account title. So like, let's say we had a company that sold some stuff in the store, but then they had some stuff that they sold online. They would put those the 2 different categories under here. In this particular company, we just have sales that are in the store. So we just put one account title. Then we put the dollar amount, and we put it in the totals column. Then we go into our expenses, and again, the title expenses, the category of expenses is out here on the left-hand margin, and then the individual items are slightly indented. And we put all of the account titles for the individual accounts slightly indented, and then their related dollar amounts in this details column. If we had 2 different categories of revenue, we would put sales, internal sales, sales online, and then we would put those in the details, and then we would put the total over here in the totals column. Okay, so just like with our expenses, where we're putting the details here, then we put the total of our expenses, and we put the total over here. We single rule here to show that we're adding this up, and we put the total expenses, and then we put the total of the expenses in here in the totals column. Then we calculate the net income or loss, and again, we would put that in that totals column. So our income or loss is just simply calculated by subtracting our expenses from our total sales and putting the total in at the bottom. We single rule again to show that we are adding or doing a numerical calculation here, and then we put the net income and the dollar amount. Okay, that's pretty much it to calculate our net income. What should this number match? It should match the net income number on the worksheet. If it doesn't for some reason, then you've done something wrong. Okay, so keep that in mind as well. Okay. Then businesses, okay. Businesses want to be able to use that income statement to make decisions and analyze how well they are doing, profitably or not profitably, okay? They want to make a decision as to what are the most significant expenses of the business for a given period of time. So how they do that is they figure out what the components of their income are. They look at and they analyze the different actual items and figure out what they represent to the total. And they want to look at what do their total expenses represent and what is their income or loss as it relates to their total sales. All the component percentages is the percentage relationship between a financial statement item and its total. And it's calculated very simply by taking the component item, dividing it by the total, and multiplying it by 100 to get the percentage. In our instance, in our scenarios, we're going to round to the 10th percent, okay? 1/10 of a percent. And how do you know if your percentages are good? And look at that as well.
How come the lines are always so small?
Because I put 2 slides on 1 page. Okay, so to try to figure out if the component percentages are good, we're going to compare how our company is doing to industry averages. So we're going to compare our company to similar businesses. And then we're also going to compare our company to itself in similar fiscal periods. So what we want to do is we want to look at, and I say similar fiscal periods because we want to look at our company in like the same month of the previous year or the same quarter as previous years, because we want to make sure we're taking out any cyclicality or seasonality. So comparing December for, say, a retail business like Target or Walmart is going to be very different than comparing it to, say, February or March. The sales volume and what is being sold is very, very, very different. Same thing like if you have a company that's like a seasonal company, like a Hewitt's or like something that sells Halloween stuff. The sales are going to be very, very different at different periods of the year. So to compare unlike periods is not necessarily a good process. You want to compare similar time periods, and you want to compare the company to similar companies to itself. Okay, so at the end, this is pretty much what our income statement is going to look like. We're gonna see that our total is going to be to the sales. So we're comparing each of these items to our total sales. So we're getting how much of our total sales are, how much of our total sales are being used up by advertising expense? How much of our total cost, our total sales are being used up by insurance expense, miscellaneous expense, etc. So this component percentage is telling us what are our most significant expenses for this business during this period of time. We want to understand that, we want to analyze that because we want to try to figure out if that's the appropriate amount for our business. It might be for a given fiscal period, but it might not overall. Yes, Kira.
For sales, would you like to modify like
Itself.
I mean like clothing sales, like other
If it had multiple different categories of sales, you would definitely do that. You would get, you would take each of the individual items of sales and you would compare it to the total to see what percentage of your sales is generated by each category. Absolutely. Yep, great. Very good question. So in this particular business, techno consulting, what's our most significant expense?
Supplies.
Our supplies expense. So if we are looking at techno consulting, do we know whether this is a good percentage or not?
No.
No, all we know is it's our most significant expense. So what we want to do is obviously we want to try to keep our expenses as low as possible. So what we would do is we would compare this to their supplies expense for the same period of time previous years, see if it's going up as a component percentage or down, okay? And we would want to compare it to companies like ourselves to see if we're good at managing our business. If other companies have similar component percentages, then we know we're probably pretty in line. If our component percentage is higher than other companies, then we know what? We might need to cut back. We might need to make this expense a little bit less. Okay? We have room for improvement. All right. This is going to show us our company, if we had a company that had multiple categories of sales. So this is just giving you an example of a company where they had internal, or what did they have? They had lessons and repairs, okay? And then we would calculate the individual component percentages here for these. This clip is just showing you the totals, not the details, okay? And this company is also showing a loss. And they're showing us that their loss was 23.7% of their total sales, which is not very good at all. Okay, so it's just going through, blah, blah, blah. Yes, if it's a loss, you're going to put parentheses. When you do it in Excel, it will automatically do it for you. Once you put a negative sign in there, it'll automatically do it for you. Okay. All right, so let's stop there and let's work on work together 7-1.